Welcome everyone, and thank you all for taking the time to join today's webinar. I'm really excited to be part of today's presentation. My name is Renika Lightborn, and I'm excited to have our guest speaker, Mr. Ferris Moussa of Disrupt Equity. And today he's going to talk about the ins and outs of starting investing into your first multifamily syndication, how to deal with structured, and typically what that deal flow looks like, and also to being able to identify the right market for you to invest in. But before I turn it over to Ferris, I do want to kind of give you a high-level overview of what self-directing is, and then, of course, some of the options available to you. If you have any questions, definitely feel free to type those in the question box, and we'll do our very best to get those answered for you. Again, my name is Renika Lightborn. I'm part of the Business Development Specialist team here at Advanta. I've been with Advanta as an employee for a little over a year, but I'm also a client, and I actively self-direct my IRA for a few years now. If you have questions or want to know more about self-directing, definitely feel free to visit our website, or you can give me a call. My contact information is up on the screen for you. So just a quick disclaimer. At Advanta, we don't give any tax, legal, or investment advice. We also encourage you to know that all of the information that we provide to you is for educational purposes. So you're always encouraged to consult or confer with your professional team, do your own due diligence before you make an investment. So just a little bit about Advanta and who we are. So we're a self-directed IRA administrator. We've been in the business for nearly 20 years. We are recognized in the industry as one of the leading self-directed administrators. Meaning we work very closely with retirement holders and investment providers to be able to use those retirement funds to invest in alternative assets. Our headquarters is located in the Largo, Florida area. I'm in the Atlanta office, but we work with clients nationwide. One of the ways that we set ourselves apart, and we're really known for, is providing our clients that high quality concierge service. You have a dedicated person, a direct point of contact, who's there to assist you and guide you every step of the way. So a lot of times when I talk to new potential clients, they often ask, well, why haven't I heard about self-directing? It's not uncommon for me to hear that statement. The main reason is most common IRAs are actually held by the larger banks and brokerage firms, and their preferred business model is stock, bonds, mutual funds. But in actuality, self-directing has been around for a very long time, since the 70s. So our role at Advanta is to kind of help educate. It's growing in popularity with self-directing, but our role is to help educate the public, to let them know the different options available to you. So I would encourage you to continue to attend webinars like today's event. We do have great guest speakers and experts. Also to check out our website, our blog. It features great content. All of our webinars are recorded, so you can always access that via our on-demand YouTube learning channel, or visit our video library on our website. So exactly what is a self-directed IRA? A self-directed IRA just simply means that you, the investor, the retirement investor, have control over your retirement funds. You get to decide what is it that you want to invest in. So it really gives you the opportunity to diversify your retirement holdings. So we mainly just deal with alternative assets. So you have the option to invest in real estate, whether it's a single family rental, or it's going to be passively investing in a multifamily syndication project like we're going to talk about today. You have the opportunity to where your IRA can actually be the bank where you get to invest in notes and mortgages, or say if private equity is your preferred space where you want to invest in, say, a private bank or a friend's startup company. You have the option to invest in the likes of precious metals, digital assets. The list pretty much goes on and on. There's actually only two investments the IRS say that you cannot invest in, and that's life insurance and collectibles. Collectibles being anything like antique art, wine, stamps. Besides that, everything else is on the table. So pretty much is near limitless. You have the ability to invest in what you know best. So some reasons as to why someone may choose to self-direct. You can choose to self-direct for, one, it could be a new source of capital for you. If you have money that's sitting in an old 401k, you can elect to roll those funds over and actually make that investment and put it to work for you. Another reason as to why a lot of investors look to self-direct their retirement account, because they're simply tired of the ebbs and flows, the volatility in the stock market. We know with self-directing, it really gives you the opportunity to truly diversify your account and invest in more tangible assets like real estate. A third benefit, of course, is the tax benefits. Having those rents and those profits flow back into your IRA account, tax-free or tax-deferred, just depending on the type of account that you have. In terms of the different types of accounts that can be self-directed, really any type of IRA can be self-directed. So whether you have the traditional IRA or Roth IRA, for self-employed individuals, you can look to self-direct your SEP IRA or simple IRA. The solo 401k, also known as the individual K plan, is, it offers great flexibility. Any former employer plan, you can also look to self-direct, again, whether that's an old 401k or it's a, TSP type plan or 403b, you can roll those funds over into a self-directed IRA to invest. Some lesser known accounts that you can also partner or self-direct is the educational savings account or the health savings account. The key thing to remember here is just more so the annual contributions between the different accounts. And then with the Roth IRA, it being taxed, the distributions being tax-free at retirement. In terms of getting started with us at Advanta, we've really streamlined that process for you in 3 simple steps. Step 1 would just actually be to go through the process of opening up your account. You can do that by filling out the application electronically, and that can take, that's done via DocuSign. You'll have someone like myself or a colleague that's there to walk you through the steps, answer any questions that you may have to get that application completed for you. Step 2 is actually funding the account. Are you going to roll funds over from an old 401k? Or are you going to, if you have an existing IRA, you can actually do a transfer. There's no personal tax liabilities to you. Or you can make a cash contribution in accordance with the IRS limitations, or any combination of the 3. And then finally, third is actually start investing. What alternative assets you want to invest in. The beauty is you have control. You get to decide what works best for you. So if it's real estate based, or if it's, again, acting as your IRA, acting as the bank and investing in notes and mortgages, or if you want to passively invest in a syndication project that Ferris is going to talk about through the presentation, or any type of digital asset like cryptocurrency or a private LLC. The list is pretty much near limitless for you. Again, this was just a quick synopsis of what self-directing is and some of the options available to you. If you have questions, you want to know more, you want to do more so a deeper dive, definitely feel free to reach out to me. My contact information is up on the screen. And I'll go ahead and turn it over to Ferris to let him start his presentation.
First off, thank you, Renika, very much for you and Advanta for, helping set this up. But I think what you guys are doing is definitely the right path. I'm a big believer in helping people get educated. I think the more educated any investors are, right, I think the more beneficial it is. And so putting together a platform for that, I think, is obviously kind of a crucial first step to really get people educated. And so for those that don't know me, I'm going to go ahead and, basically I'm presenting about the ins and outs of multifamily investing, right? And really from the syndication aspect. And I'll tie that back into self-directed IRAs and 401ks and how that works as well. And so a little bit about myself. I actually grew up kind of in the tech world, right? My background is tech. I graduated computer science from University of Texas, and I actually went and worked at Microsoft for several years. And I left Microsoft, started a software company, had that going for several years. And, kind of similar to probably a lot of people in the audience, right? I was starting to look at, how I want to invest my money. And I started learning a lot more about real estate and, kind of hopped right in, fell in love with it, and realized kind of syndication is really the things that I like, which is systems, peoples, and operations, right? And so there's the people aspect around investors and brokers and relationships. There's kind of the systems and operations aspect around how do we make sure we perform? How do we make sure we differentiate ourselves from others? And so, with that started Disrupt Equity with my partner, Ben Suttles, and, we've been rocking and rolling since then. And so us as a company, we primarily have assets throughout Texas and Georgia. Those are kind of our two main markets. And, we're looking to continue to grow that. And so really, Disrupt Equity as a whole, we also have kind of other strategic partnerships that we've been kind of putting together. We are vertically integrated, so we have our own in-house management company. We have kind of strategic insurance group as well, which is kind of the commercial insurance arm, peak financing. And really, I want to highlight Investor Academy as well. Similar to kind of Renika and Advanta, right? We believe in education is key. And so we put together a platform where, essentially we are having experts come in and teach various aspects. So obviously, we can talk about the multifamily, but we will bring on people that are talking about other things, whether it's mobile home parks, whether it's stocks and bonds and gold. And so that's a big focus for us as a company to help get more awareness out there. And so before I hop into this presentation, right, just a quick disclaimer, similar to Renika, I am not a legal professional. I'm not a accountant. I mean, please consult your legal professional. But for those who don't know me, I'm a pretty open book. I'm very candid and transparent. And so I'm happy to talk about things and help give, my opinion, my thoughts, my advice, but definitely please consult your legal and tax professional before you make any big decisions. And so with that said, right, for this presentation, I kind of wanted to just my intention is really go through multifamily investing, what it's about, right? Kind of the process, the deal structures, how people can get started, how to analyze the opportunities, and then really what the investing process looks like, and then go through an actual case study of a deal that we did that coincidentally it's in Renika's backyard. It's over in Decatur, and it's a deal that we actually sold this past November, just to kind of show that as an example of what we looked at and kind of how we identified the asset and what happened during the play. So first and foremost, right, multifamily investing and why we love it, right? It's for us, we're looking for cash flow, right? We are cash flow investors, and for our investors, they're looking for cash flow as well. And so, it's a nice way to get into an asset that is cash flowing. We actually, I realize that's not updated. We do monthly distributions now, right? We're a big believer in, hey, this is a cash flowing business rather than quarterly. Why don't we make it monthly? So it's monthly mailbox money, right? Cost segregation and 1031 exchange. For those that don't know what this is, I highly recommend you look it up. But essentially, with anyone that invests in our syndications, right, we are able to give them a very large amount of losses that pass through to the investor. And so to highlight a quick story, I had a good friend that had invested on one of our assets. He had invested $75,000 on it. And we had done a distribution. I think that was a deal that closed around August. And so we did a distribution before the end of the year. But then come February, he received his K-1, which for those of you that don't know, if you are a shareholder in an entity, right, you get a K-1, right? That as a partner, you get that. That's the tax document that you get, similar to what you get for, maybe if you have a W-2 job. Well, he got his K-1, and on that, he actually got a $60,000 paper loss. And he called me, and he's like, hey, Ferris, he turned into a white-collar criminal. And I'm like, what do you mean? And he was just surprised to see that he's able to not only invest, not only get a distribution, but also get $60,000 of losses, which in his situation, he was actually able to apply that towards other income and really, reduce his tax burden. So it's a very powerful thing. I think most people don't realize it until they get into it, but, it's a good way to help reduce your tax burden. The next thing I want to highlight is really with commercial real estate, you're able to do what we call forced and natural appreciation. And so forced appreciation is really the way commercial real estate is valued is based on how much income it makes. And so if you can help boost the income, you've actually increased the value of the property whenever you go to sell it. Whereas maybe a house that you're buying in a neighborhood, right, you can't really increase the value because it's tied to the rest of the neighborhood, right? Even if you put, $300,000 into updating the property, there's no guarantee you're going to get that if you're already the most expensive property in the market. The next thing, again, the tax benefits and depreciation, right? Highlighted that. Low interest rates, right? We are able to get into deals. I mean, especially right now, we're looking at deals where our interest rate is 3 to 3.5%. It's 30-year amortization, 8, 10, 12-year notes. And sometimes we're getting, 1 to 5 years of interest only. And so again, it's actually some of the best debt in the world. And it's a big reason that, multifamily is so attractive and why we're starting to see more institutional equity get into it. And then that naturally leads over to leverage. Right? Whenever we're buying assets, we're going in leverage, right? We are getting, we're taking on debt, but it's the good kind of debt, not the bad debt. It's not debt we're taking on to go buy a fancy Ferrari somewhere, right? It's debt that is actually helping us leverage that investment and really squeeze out better returns for our investors. Because if we're able to get debt that's 3%, but we're actually able to pay out the investor 7%, right? It's just helping us scale that. And then last but not least, scalability, right? Both on our side of the table, as well as on the passive investor side, it's a business that can scale, right? It's a lot easier. You have 200 units on a property versus one house. And, me personally, actually, I started on the residential side, and that was my biggest qualm, is that it doesn't scale very well. And so with that said, right, ways people can invest. I think I get this question a lot. How can I get involved in multifamily investing? And really, there's kind of a couple of different ways. The first one is really the most simplest one. It's investing passively in someone's deal, right? It's not really a lot of time needed, right? It's very much a passive investment, right? But you are getting the benefits of it, right? You are a member in the entity. You are getting the tax benefits. You're getting the cash flow and the appreciation as well, right? The next one is really buying your own deal. And again, you can do that, right? I know a lot of people that try to do it at 20, 30, 40 unit properties. And, from our side, the issue with smaller properties is that you end up not having good economics of just really staff, right? You have kind of, in our world, we like to say that basically for every 100 units, you have one person in the office and one person on the maintenance side. Well, if 1 and 1 can handle 100 units and you still need a person in the office for 30 units, you've essentially, you're overpaying for on the payroll side. And so, 30, 40, 50, 60 unit deals don't really scale well. And so for us, we like to be kind of at the 90 and above in terms of unit count. And so if you're looking to buy your own deal, my first recommendation is try to get to that 80, 90 unit if you're not going to self-manage it. And if you are going to self-manage it, you're going to try to do a 30 unit because you can't, there's not enough meat on the bone to hire on a full-time staff. Well, just realize that that's going to be an active investment. It's not going to be a passive investment. There's a lot more kind of involved in that aspect. Next up is really partnering with someone doing a deal, right? It's okay. I like to say getting a slice of a bigger pie is much better than getting a smaller slice of a small pie. Sorry, than getting a bigger slice of a small pie or getting a piece of no pie, right? There's a lot that goes on in doing a syndication, right? And, find other people that have done it and figure out ways to add value to them, right? So that way you're able to get in on the kind of the partnership side, you're able to learn the ropes and get exposure. And and again, I'm happy to talk through these, right? I'll do questions either now or at the end, and I'm happy to kind of go through some of these key points and help really expand where people are interested in. Really, I'm doing this presentation for the audience, and so I'd love for you all to kind of think through questions that you have, and I'm happy to dive into them. So option number 4 is really syndicating your own deal. Again, I recommend doing number 3 if you're going to do number 4, just because, again, it's not that syndication is hard. It's just that there's a lot of pieces, and just kind of having that awareness, knowing what things happen, when, at what time is I think, crucial. So kind of making sure you've gotten some sort of experience prior, I think is really helpful. And then last but not least, right, again, you could also invest in REITs, right? That's more of kind of the institutional route. It's a more liquid investment, but you're not really a shareholder in a multifamily investment. You're a shareholder in a company that happens to be buying them, right? And with that, you're not getting a lot of the benefits that you do get with commercial real estate, right? Really specific, I'm talking about the taxes, the biggest one around. You're not getting a K1, right? You're not getting the tax benefits that come through. And so those are kind of the big buckets of how you can get involved. And each of these kind of have, there's a 1A and 1B and 1C and 2B and 2A, 2B, 2C as well. But those are kind of, hopefully that helps give people the lay of the land of, the different ways that they can get started. All right.
Ferris, I do have a couple of questions that came in for you.
Okay. Yeah, well, let's go do them.
Okay, perfect. So one of the questions is, do you invest in Class A, B, or C properties? And if so, why did you choose that asset class or the type of property?
Yeah, so great question. So for us, our bread and butter has been C, B asset classes, but we are starting to look at more A classes. And so maybe to give a little bit of context. So C and B is really where we can do kind of the most straightforward, what we like to call value add. A property that we are buying, we are putting capital into it, right? We're investing $1-2 million into the property to improve it. And again, I'm going to go through a case study at the end and kind of talk through some of those things. But we are essentially doing things to improve the property, create a better community, right? And from that, be able to increase our income. And so whenever we increase the income, we've now increased the value, we've increased the cash flow. And so it's, it's a much better performing asset. Now that said, as of late, we've been starting to see that really the CB value add is starting to get overdone, getting overpriced. And so A-class opportunities are starting to look a lot more attractive. And so we have been looking at A-classes. I mean, we actually offered on 3 the past 5 days. And so, we are looking more in kind of that B plus A minus class. But it's ultimately, I like to say as a syndicator, we're really glorified matchmakers, right? We are matching deals to equity. So we're out there looking for deals, and we're looking for equity groups that's a fit, because we do have equity groups that only want to do A class in the best area. They're okay with less returns, right? As long as they're in a much safer asset class, right? And we're going in less leverage. versus we have other investors that are looking to just maximize all they can. They don't care about getting any distributions. They're just looking for getting the most bang for their buck over time. And so it's ultimately about kind of what you're comfortable with. And from Disrupt Equity as a whole, we're really kind of expanding into all three of them.
Great, great.
All right. Was there any other questions, Renika, or shall I continue?
Well, one more question that just came in. So you mentioned I guess the real estate cycle. Have you experienced, or have your team experienced the full real estate cycle in terms of the ebbs and flows of?
Yeah, so we've had several deals that went full cycle, right? That we've bought them, done our plan, and we've made the exits on those deals. And so we've kind of had 3 deals that we've gone full cycle on as of today. And there's other deals that we will just do a refi and hold on to.
Okay, great. That's the questions for now. As they come in, I'll let you know.
All right, I will continue then. So let's see. So next up is really, as getting into any multifamily deal, whether it's a deal that you're investing in passively or you're looking to actively do, right? It's really important to understand the deal structures. As a passive investor, I recommend everyone read your PPM, right? Where as an investor, you're given a PPM. That is the SEC required legal document that we must provide. And you're also given a company agreement. And please read these, because, I've seen other operators that'll kind of do things, I'll just say uniquely in them. And you as an investor, you end up agreeing to it. And so really understanding them. But the biggest kind of key aspect that people look for is the deal structure, right? How is the deal structured between, how are profits and income split? And so kind of these are the 3 most common ways, right? The first one is a straight split, which is basically on profits, right? 80% goes to the investors, 20% goes to sponsors. Now, the next common way, and this is actually what we do because I think it's much better at aligning incentives, right? I'm a big believer in saying like, look, we are motivated whenever we make money for investors. And so we do a preferred return model, which really the way a preferred return works is that essentially as a sponsor, we are saying, hey, investors, we will give you an X amount preferred return, right, annually before we can start to share in any of the profits. And so let's just go through a quick example, right? If we have a deal, let's say it does no cash flow year 1, and then in year 2, it does, let's just say 10% cash flow, and then we sell the property. Well, we've had investors' money in that scenario for 2 years. And so let's say it's an 8 pref, right? Most of our deals we've done is an 8% preferred return. Well, what we're saying is year 1, we owe 8%. In year 2, maybe we did do 10%, but we still owed the other 8 from year 1. And so we have to give investors 8% and 8%. And then on any money that's left over, right, then we are splitting that with our investors. And so it's really kind of saying investors get put first in returns. Once we've hit something that we've kind of agreed to, right, then we are sharing the splits. And maybe to go back really quick on the straight split as well, that's on profits, right? And so let's say that we sold an asset. On the sale, the way the sale stack works is that basically, first we pay off the loan, then we return the investors their investment first, right? So if an investor put in $100,000, we need to give out all the money back until investors have been made whole on their investment. And then any money that's left over, that's what's being split, right? And similar with the preferred return, right, it's only on the profits. And so really that's designed to protect the investor's initial investment, right? Where, look, your initial investment is not, we're not going to take a piece of that ever, right? It's really on the profits that happen afterwards. And then last but not least is what we call a waterfall structure, right? Where it's really a little bit of a hybrid, which is basically an agreement saying, look, we're going to give maybe a 70-30 split until investors have hit this return. And anything above that, then we're going to split 50-50. Right. So it's really kind of with a waterfall structure. A lot of times it's kind of for an investor, it helps protect the low side, but for a sponsor, it helps them maximize the upside, right? Meaning if we home run deals, and a sponsor is actually getting more of the upside. And, we've had several deals that went full cycle that have been home runs. And, had we done a waterfall structure with a bigger split, I mean, us as sponsors, we could have made more. But again, we're really big believers in making sure our investors are made whole. We're looking to continue to, build a business around that and not really kind of squeeze juice from any one deal. So if anyone had any questions on those, I can pause there. Otherwise, I can keep going.
You can keep going. No questions yet. I'm answering just
all right.
questions.
All right. And so with that said, right, how do people get started? I think the first thing, like we mentioned, is education. It's getting on webinars such as this, learning, kind of nuggets here and there and what it's about. There's a ton of content out there. There's podcasts, there's books. And again, I'm happy to make recommendations for any of those if people are looking for them. But really, get educated, because while it sounds simple at the surface, and yes, it is kind of very passive, I think it's important to just understand what you're getting into. And me, as a sponsor, I love whenever my investors are educated, because that means they understand what's happening, right? And as kind of the market shifts, that they understand kind of what we're doing and why we're doing it and how we're doing it. Next is really from that, identify the role you want to play, right? I talked about a couple of different ways for people to get involved. Figure out what's kind of a fit for you, and then that really leads to the next thing, which is, what is your personal investment criteria, and does that role match that, right? And this kind of goes to the question that was asked earlier around, do we invest in A, B, and C? Well, you as a passive investor, need to understand the pros and cons of each of those and figure out which of those matches your investment criteria of what you're looking for. Then next up really is build your network and find opportunities. I think this is key. Real estate is absolutely a relationships business. I wish I had realized that whenever I was in my tech world, right? Where, I think with tech, it's less of a relationship, whereas real estate, it's all relationships, from brokers to investors to other operators to partners, et cetera. And so, there's a lot of opportunities out there to go meet other people. There's local meetups. I mean, I actually met my partner at a local meetup at the time. There's big conferences. I mean, we actually have a conference that we do 3 of every year as well. We didn't do it obviously this year with COVID, but actually we did. The last one we did was this past February, so right before COVID happened. But again, getting out to these things, getting educated, meeting other operators, other passive investors, other sponsors. And then last but not least. Uh-huh.
I'm sorry, go ahead and finish up, and I have 3 questions.
No, I was going to say, the last but not least, invest. So nice, short and sweet.
Okay, perfect. So the first question that came in, it's, did you say that the interest is paid on the initial investment only, or also is it compounded? So that's basically.
Sorry, is it compound?
Compound.
So I think they're talking about the preferred return. So the preferred return, essentially what it says, right? Let's just keep it simple. As a passive investor, let's say you invest $100,000 into a deal, and that deal is an 8% preferred return, and then the splits after that is almost irrelevant. And here's why. What it's saying is that before the operators or the sponsors, so maybe one quick side note, sponsor, operator, syndicator, those are all synonymous, right? They're the same thing. Now, with an 8% preferred return, what it's saying is that the sponsor has to make sure that the investors received 8% annually on their money first, before the sponsor is allowed to take $1 from the splits. And so if it's an 8% preferred return, right, let's just go through a hypothetical. Let's say there was a deal where year 1, it paid out 2%, and year 2, it paid out 10%, right? Well, now from year 1, right, we actually, if you think about it, the preferred return was not enough, right? We paid 2%, but we're supposed to give 8%. And so now we owe investors 6%. Now in year 2, right, let's say we're able to do 10%, and that's on their initial investment. So that's on the $100,000, right? It's always on the initial investment amount. Well, year 2, there's 10% to give out. Well, actually, as a sponsor, we wouldn't take $1 from that, because guess what? We have to give 8% year 2, right? But we still owed 6% from year 1. And so that 2% would go to the investors. And really, hopefully, year 3, right, we need to get our revenues up. And so that's what it means with a preferred return. And for all of these numbers that I'm presenting, it's always on the initial investment, because really, right, we're giving you a distribution. Your investment initial capital does not change. That distribution is just cash that you're keeping. And I guess to also add to that, this goes back to what I said earlier about reading the operating agreement and the PPM that you're investing in. I do know some operators will pay down your investment with each distribution, meaning if you had to put in a $100,000 investment, and then let's say year 1 that you received a $5,000 distribution, rather than keeping your initial capital at $100,000, they'll actually say, well, we gave you $5,000, now your initial capital is at $95,000. And so then moving forward, the preferred return is on that 95, right? Which, to me, I think that's it's a different structure, right? I don't want to I wouldn't say one is better or worse, but I think that favors the sponsor side more, whereas I like to keep our investors kind of whole, right? It's based on their initial investment.
Okay. Next question I have, you answered 2 of them relating to. So do you have any you talk about educating and, of course, building a network. Question came in. Do you have any recommendation on, where to go and get educated? Any calculators, any tools, any additional resources to kind of
Yeah,
help speed
absolutely.
up the process.
Yes, I'll say a couple of things. So if you know nothing about real estate, there's a book called The Millionaire Real Estate Investor, written by Peter Keller or Gary Keller. I forget the first name. He's the founder of Keller Williams, actually. And it's a good book because it's not specific to multifamily or to, commercial real estate or anything like that, but it talks about the pillars of real estate and what makes real estate as a whole attractive, right? Now, from that, I believe multifamily is by far the best subsection of real estate. But I think that's a really important book. It's kind of an eye opener. He does a good job just talking about, how a couple that makes, I think, $50,000 a year can retire millionaires, right? And it with a very simple example of what they're having to do. So I highly recommend that book. If you're looking for more specific things, right? There's a group that we're a part of called MultiFamily Masters. You should definitely check it out on Facebook, website, and that's really a national local meetup group. And, between the online kind of events and the local meetup group, I think that there's a lot of content there, a lot of exposure, right? We have investoracademy.net, which is kind of our platform that we're starting to put together. We just launched it recently, which again, right, we're trying to record high quality content and doing deep dives on these topics to help get people exposure. From that, there's another book that a friend of mine that I know that wrote actually called Crushing It, where again, he's talking about, his story and investing in apartments. And he kind of went down the doing it himself route and doing smaller deals in the Northeast. And so that's a very good book as well. And so those are maybe kind of the biggest ones that come to mind. And again, if anyone wants specifics on other things, I'm happy to talk through those.
Okay, one final question that just came in. So how long do I have to keep my money in the deal? Or, how long do investors have to keep their money in the deal? Is there required?
No, that's a good question. So it's deal specific, right? There's not a one size fits all. And, as part of a sponsor, they have to present the deal. And, even with SEC regulations, they have to explain what their plan is with the deal. And so most deals are about 5 to 8 year holds between buying and selling. But there's also deals, and again, the deal actually I'm going to showcase was a deal that initially the plan was to do a refi partway through where we give investors back most of their deals. And there's actually another deal that we're looking at right now, that it's not a deal that we have yet, but a deal that we're exploring. And the way we're modeling it is saying, look, if we did a 100% refi in year 3 to investors, then we hold the deal for another 7 years, right? What does that look like? Because I love owning deals where we have zero money in the deal, right? Where as an investor, you basically own this huge asset without any more money in the game. So.
Okay, thank you.
All right, then I will keep going. Right, so kind of going through the different aspects, right? What does it look like, as a passive investor? And I think really you have to vet your deal sponsor, right? Whether it's someone you met in a conference, someone you met on a webinar, or anything else, right? Look at their track record and ask them, and just be candid. What has been their best deal and what has been their worst deal? I will absolutely talk about my worst deal, and I'll talk about the best deal. And it's not that every deal is perfect, but it's up to the operator to kind of work the deal, and problems happen, and just kind of being able to identify the problem, put together the plan, and kind of execute, right? I think a lot of people fixate on the acquisitions part of multifamily, but to me, that's actually the easiest part, right? I think people fixate on it because it's hard to find a deal, and they don't know how to raise millions of dollars. But really, the hardest part of multifamily is about executing the business plan. And so, making sure your sponsor knows how to execute a business plan. Do they have a team around them? Have they done it before, et cetera? Next up is, understanding who they partnered with, right? Who is their team? And really, does that investment criteria match yours, right? Is the sponsor doing A-class investments where the returns are a lot less, and you really just, you're okay with taking on more risk and you're just looking at maximizing your returns? Or is it the opposite, right? Looking and seeing where are they investing, right? We like to invest in markets that have job growth, population growth, and price points make sense. And that's actually what led us to go buy in Atlanta, right? We were in Texas. Texas started to get really expensive. And while Texas has great job growth and population growth, and we've done well on our assets there, prices were starting to get high and there wasn't enough cash flow. And so that's what led us to Atlanta, and we've done amazing in Atlanta. We love Atlanta. So, you as an investor, just kind of understanding and being comfortable with where that deal is, right? And what the story is. Talking to the sponsor and asking candidly, honestly, do you have any foreclosures, any missed mortgage payments, or any lawsuits, right? Again, you need to understand what that person is, what are they doing, or their firm are doing, right? Because again, it's going to be a long-term relationship. And last but not least, seek feedback from their current investors and partners, right? I've had other investors ask, do you share your underwriting model? And I said, absolutely, yes. And I guess I was surprised to see that other sponsors sometimes don't. And so, I think as an investor, it's important that you get to see the full behind the curtain, right? There's nothing, it's an investment that you are making. It's your hard-earned money, and making sure that the sponsor is giving you all the visibility you need to make sure that that's the right investment for you. Right. As well, the other side of it. Now, how do you kind of vet the offering itself, right? And so first and foremost, I'm a big believer that sponsors should invest in every deal. Every single deal we do, we typically are investing 5 to 10% of the investment as well from our own pockets, because again, it goes back to aligned interest. And so as a passive investor, I'd be very hesitant to invest in a deal where the sponsors aren't putting any of their own money into it. Next up is really understanding what the deal structure looks like, right? Is it a preferred return? Is it just a split? Is it something else? And, making sure that matches what you want. And that really leads to the next question, which is, what is the expected hold time? And again, as a passive investor, are you okay with that, right? I've seen deals that are designed to be 12-year holds, and that's okay, right? I mean, if they're cash flowing, nice, safe asset in a great market, and you're paying down the loan, et cetera, I mean, that's not bad, but just making sure that that makes sense for you. Understanding the fee structure across the board as well, right? Everyone does things differently there, but making sure you as a passive investor understand that. Understanding the business plan, right? Is it a renovation? Is it a deep value add? Is it a reposition? Is it something else, right? Understanding what that is. And kind of last but not least, right? What types of returns are they projecting? And again, I'm going to go through a case study where I show you all some of the slides that we actually presented to investors and kind of how we, looked at these things. Right. And so for a passive investor, right, what is the actual process? Well, honestly, we have some investors that we don't hear from until we have an offering. They hop on our webinar. For us, we like to do a live webinar with all of our investors. We email it to everybody, and really, it's an open book. I mean, we tell people to hop on, ask questions. Every investor can see everyone else's questions because, again, we want full visibility and nothing to hide. But really, we have some investors that only show up, they hop on the webinar, they fill out the paperwork, wire the money, and then they kind of check out, right? And they, everything else, they're kind of on cruise control, right? Whereas other investors can be more involved. And so really, but the process can be as simple as what I was talking about. And so, during the closing, right, you review the deal, the agreements, and you're filling out the paperwork on wiring the funds. During the hold, right, we send out monthly updates on every asset. And so I think, again, that's important to give full visibility, where we are actually taking the time to write up what's happening, the good, the bad, the ugly, and we include all of our financials, the full packet, right, so investors can see everything that's happening. And again, doing distributions, right, whenever it makes sense for that asset. For us, we've moved to a monthly distribution model. But as a passive investor, you're just getting money ACH into your account. We no longer mail checks. So we did do that recently for a deal we sold, just for the kind of investors can frame it and have it, but typically we're doing ACHs. And then last but not least, right, as a passive investor, you do have some rights. And so, you may be called upon to do that. And so to give you guys an example, the deal that I'm going to give the case study on shortly, right, really, we hadn't heard from most investors throughout that hold, and at the very end, we have to reach out to them saying, hey, we wanted to get approval to sell the deal. Here's what the deal, here's what the offer we have looks like, et cetera, et cetera. So then investors did have a little bit of work to do, which is really giving us the approval, right? And then, working with us to get their return of capital and the return of profits. And last but not least, right, this is really where you as a passive investor can use your, self-directed IRA or 401k, right? And so talking, with Advanta and understanding that process. And it's really, it's not much more. It's really nice and easy to do, especially with a good operator such as Advanta, right? Where they, this is what they do. And so you are able to invest in these through your self-directed IRA and 401k. And the key to catch those is making sure you have a sponsor that's willing to accept it, right? Because on the sponsorship side, it's a little bit more paperwork as well each year. But again, it's really nominal at that. And so, I think that's a very powerful vehicle. We see about a third of our investors actually are using self-directed IRAs and 401ks. And so it's definitely a very popular way to get involved into kind of multifamily syndication.
Okay, Ferris, I do have 3 questions that came in. Speaking of self-directed accounts, question is, what percentage of your investors use their IRA to invest with you, and how many of them are repeat investors?
Yeah, so for us, I mean, I want to say about 20 to 30% of people use a self-directed IRA. And we have that logic and math, and so that's kind of the number of people. And honestly, for me, the best investor is a repeat investor, and that's why we like to take care of our investors. And so a lot of our investors are repeat investors. I don't have the exact number, but most of our investors, we make an exit, they're investing in the next deal, absolutely. And so we actually did an exercise recently where we saw that one investor actually brought on 13 of his friends as well on the next deal. And so, it's important to make sure that, we provide a good opportunity and we do a good job and perform, right? Because for us, that it's always better to have the same investors continue the asset.
Okay, next question. Again, just quick disclaimer at Advanta, we don't endorse any particular investment. You're encouraged to do your own due diligence. But the question is, what is the minimum investment? Is it based on a project, but do you have a minimum investment buy-in?
Yeah, so it's deal specific, right? Every sponsor kind of has their minimums, right? For us, it's usually a $75,000 minimum, but again, it's deal specific. And sometimes, some sponsors, including us, right? For someone's first time investing with us, we'll let it go down to 50,000. But again, that's case by case. So I don't want people to think that's like a rule of thumb in the industry.
Okay, and the next question, can you provide the investor IRR for the past deals? So
Sorry, what was can you provide the investor, what was the word you said?
So, I'm sorry, next question, what is the investment by FLP? I'm not familiar with that, what they're asking. Investment by FLP, are you?
You said SLP is like S like Sam?
S is a friend, but I'll disregard that question and just work with them directly. Okay. So you can proceed with the next one. Let me just get clarification on this question.
All right. Perfect. Yeah, and sorry, Renika, for some reason I can't see any of the questions, so I'm just kind of having to hear them from you. All right, let's keep going. And so really I wanted to go through a case study because I think a case study is the most powerful way to just kind of see what can be done. Right, and so this is an asset that we bought, when was this? This must have been April of 2018, I believe. Right, it's a deal that in Atlanta that we bought. It was called Laurel Mill at the time. We since rebranded it to Woods Decatur. And this is what it looked like. And to be honest with you all, this was the best angle of the property, right? I mean, the property, had some hair on it. Well, like what we like to say, right? It needed some work. And I'll kind of speak to that here shortly, but this is what we presented to our investor, right? Before we bought the deal, this was actually straight from our presentation deck. And so on this deal, it was a high cash on cash play, right? We were expecting 10% cash on cash, which cash on cash, for those of you that don't know what that means, that really means the cash a investor is getting, right? It's not just the total cash flow of the asset, but for a person that puts in $100,000, they can expect an average 10% return on distributions, which is different than total return, right? Because whenever we go to sell the property, you also make a pop. And so 10% cash on cash was really each year getting 10%. This play was really modeled to be 100% return over 5 years. This deal, we were only doing $900,000 of improvements, but really, why did we like this deal, right? Location is key. I'm going to show you guys that on the next slide, but we knew that it was a rough area, but it was trending kind of that, it's expansion, and probably Renika can speak to it, but really kind of, what's happening in Atlanta and the corridor, kind of that I-20 corridor going east, we could see it. Each exit was improving, and we were kind of on that path to success. Next up is really management. The current owners had no idea what they were doing. They should have never owned an asset, right? I mean, it was self-managed, and they just poor boyed it. Everything about it was just not well managed at all, and that was clear as day. And, again, we knew that there was high demand. The deal across the street was fully occupied, and so we knew that if we got the property cleaned up, got the units turned and online and rentable, we could perform. And so really, if you take a look, this is the deal. But you can see what's happening to the west of us, right? We're that red dot in the middle, but you can kind of see, what's happening in the market and why we liked it. And ultimately, our strategy worked, and I'll show you guys kind of what happened on this deal. But it's those kind of things that we look for to figure out, how do we continue to improve. And so this is what we presented to investors, right? And I wanted to show this slide for a couple of reasons to kind of talk through things, but also if you look at it, right, we were planning to do a refi in year 3 where we gave investors back 13% of the investment, so kind of a low thing. But then after that, we were making about 15% annualized on cash flow, right? that's that cash on cash return. And so, this is typically what we show in each deck, right, with a kind of a sample investment and how do we kind of structure that and what does investor expect. But if you look at it, right, on this deal, we were presenting basically within 3 years, investors would have gotten 42.7% of their money returned between cash flow and the refi. And we still own the asset, right? And so that's what investors went into this thinking. But let's look at that kind of what actually ended up happening, right? This is the actual result. And so this was a deal that was what we like to call a full reposition. I mean, we had to come in and clean out the property in terms of all the bad elements, right? Between drug dealers, other things that were happening on the property that was just not, well taken care of property. We ended up, honestly, the people that owned it before us had it at 78% occupancy, but it was really what we like to call a heads in bed situation, meaning that they were just letting anybody lease, right, that wanted to. And we ended up taking occupancy. Honestly, it was actually below 55. I think it was down to 40% occupancy, right? And got rid of all the bad elements. But guess what? The people that we kept were the good people, the families. And once we kind of cleaned out the bad element, then we started to improve the property. We brought on a playground, picnic tables, barbecue pits, and really, made it a family-friendly environment. We love to make family-friendly properties because families will take care of the property better than anyone else. They'll continue to stay at the property, right? And from an operations perspective, it gets a lot easier. So this deal, we brought security in to really help clean it out and really, identify the problem makers. Then we improved the property, started updating units. We were able to push rents. And in the span of 4 months, we tripled how much money we were collecting, right? I mean, that's an amazing kind of situation. But ultimately, right, throughout the whole, from an investor perspective, we ended up actually selling this asset, right? At the 18-month mark, we knew we were sitting on a lot of equity. We had gotten it to 95% occupancy. And really, we had kind of two paths forward, right? We could either do the refi early. We had planned to do it after year 3, but we were kind of 18 months in. We could have chosen to do the refi and probably gotten a significant amount of the money out, a lot more than that 13% that we initially presented, right? Or we could sell. And we kind of took a vote, and we had a really strong offer, and we ultimately decided to sell that asset, which that closed this past October. And really, in 18 months on that deal, our investors made a net return of 80%, right? And so this is, and we have a few other case studies as well. And I just like to preface them, meaning that that's what happened with these, but that's not what we presented. That's not what our investors were expecting, right? We go into it with kind of a conservative mindset, a conservative look of here's what we should be able to do, right? And then we do everything we can to kind of help accelerate that and see what's possible, right? And so it's important to not expect these kind of returns, right? Expect what was presented on this slide, right? And then, it's up to the operator to help execute and get the performance on this slide and or, improving from there.
Ferris, right, I do have a couple questions.
Yeah, well, we'll go through this slide and then I'll ask a few questions because I think they tie together really quick. Actually, I think this is my second to last slide.
Okay.
And so to kind of just to tie it all together for that deal, right? That deal we had raised, 1.1 million. So it actually wasn't a very big deal. It wasn't a very big raise. It was a 99 unit property. I think we bought it for about $4 million, right? Whereas right now, most deals we're looking at are about that $15 to $30 million purchase price. But it was a nice, it was a deal that we knew could be our first deal in Atlanta that we could home run and perform on to help us get into Atlanta. That was kind of our mindset. All right, so purchase price there it is, $3.9 million. We ended up selling it for $7 million, and so we profited $2 million. And so I guess that's the end of the case study and really the end of my presentation. And so, if anyone would like to reach out to me, there's my email address. You could also go to our website and reach out to me there. But as I mentioned at the beginning, I'm happy to do Q&A. And so, Renika, I know there's questions already. Feel free to ask them, and I'm happy to kind of go through them and speak to them.
Okay, perfect. So yes, I did have a couple questions that came in. So one's relating to obviously the current climate with the pandemic. So has COVID has restricted evictions and requires deferred rental payments. How is this impacting your current deals or proposed deals? How are you adjusting to the current environment?
Yeah, great question. And honestly, so we have our own management company, so we manage in-house, and that's been a blessing because honestly, June and July have been pretty much the best performance we've ever hit at all of our properties. And so we've really just had to manage more effectively, right? Work with our staff and to work with the tenant base around, who actually has COVID and who's using it as an excuse, right? And how do we help kind of really keep performance up? And so So far, it's gone well, but also just the government stimulus and all of that has helped make that easy, right? So, it's kind of TBC what the future is. But for us operationally, we've just been we've been shoring up cash, kind of slowing down on all the capital improvements just so we have a lot of cash on hand, just because we don't know what the next 6 months look like.
Okay, so which leads into the next question. So what's your current outlook for the syndication market as a whole, given the current climate?
Yeah, so I think, syndication as a whole, it's obviously a very popular way to buy commercial real estate. I don't think it's going to go away. I actually think, again, we're buying assets for 5 to 8 year horizons, right? We're not buying it for a 1 year play. And so I actually think in the long run, I think multifamily cap rates are going to compress, meaning that the properties that we own are going to be worth even more. And the reason for that is if you really kind of think about all of the money that just got printed and injected into the market, right? Well, that's going to trickle back up to the companies that know how to invest, and they're going to look for somewhere to place it. And honestly, with 10-year treasuries so low, right, it's almost not worth putting $1 into 10-year treasuries. And so then, they're looking at other cash flowing assets. And honestly, commercial real estate is kind of up there. And really with multifamily specifically, right, the government kind of reminded everybody that, guess what? After people eat and drink, they need to be able to sleep. And so, multifamily is a very resilient asset class. And that's really ultimately why that's our kind of focus and our bread and butter.
Okay, so another question that just came in. I know we talked about it briefly in terms of percentage of investors using IRAs, but this question is, what percentage of your investors use cash versus their IRA accounts? Or if you can give that estimate.
It was cash versus the IRA, so 20 to 30% are cash. That means 70 to 80% are, 20 to 30% are IRAs. I mean 70 to 80% are probably cash. And we have at least one. We have some investors that will go actually use debt to invest, right? Meaning that they can go get money for let's just say 4%, right, return, but then they will invest it in in an opportunity that we have that's obviously the projections are higher than that 4%, and they're playing the spread, right?
Okay, another question that just came in. What is your best strategy in terms of building in for worst case scenario for your investment projects?
Sorry, best case scenario for building in what?
For your worst case scenario for an investment, like, okay, what's your strategy to kind of hedge against?
Got it. Okay. No, so it's about how do we mitigate risk, right? And for us, more importantly than return on my investment, it's really return of my investment, right? And so we're really big on making sure that, for an investor, can their principal be made whole, right? Because I think that's, you don't want to lose any money, more importantly than making money. So for us, it's really about the investment, different opportunities or different risks. We actually have a deal in Atlanta that we bought at 65% leverage because we were able to get 5 years of interest only. On that deal, I could pretty much intentionally try to derail that deal and it would still be able to pay its note. And, and we're sitting on a lot of equity on that deal. And so ultimately, every deal is different, right? The deal like I presented, that was a higher risk deal, right? It was not nice long-term debt because you couldn't get it on a deal like that, right? Because it wasn't performing at the time. But investors' returns are a lot higher. And so, us as sponsors and good sponsors, our job is to continue to mitigate risk at every step of the way. And there's a lot of different kind of tools and levers that we can use to do that. But it's really case specific.
Okay, now in your earlier slide, you mentioned in terms of doing due diligence, the question just came in, how to evaluate a deal from an investor perspective?
Yeah, so I had a slide on that earlier, so definitely recommend taking a look at that. But ultimately, you first need to vet the sponsor, and then you're vetting the deal in terms of the location, the business plan, right, what the returns are, where's the deal currently operating at today, right, versus where's the syndicator projecting, and do you think that's achievable? Right, and understanding what the splits and what the structure is, right, is kind of, I think, key as well.
Okay, one last question. Wait, just bear with me one moment. Do you have any foreign investors in your deal? What's the best structure to invest with you if I'm international?
Yeah, it's a good question. So we do have some American nationals that are living elsewhere that do invest. right? We do have some people that have invested from Canada, right? And, and we will take foreign investments. It just needs to make sense because depending on where it's from, A is kind of the first question, but then B, we just have to make sure we're able to stay compliant, and there's some tax withholding, some other things. And so if someone, is interested, feel free to reach out to me directly, and we have to kind of talk through that a little bit.
Okay, another question that came in. I know you mentioned that, your focus is Atlanta and Texas. Question is, what about portfolio properties to diversify your list? Do you have a preference on why you chose those two markets or areas?
Yeah, so those are markets that we like because job growth, population growth, and price points of deals, right? We're starting to feel like we might get priced out of Atlanta. I don't know if we'll be able to buy more deals in Atlanta. It's just starting to get expensive. We actually have a deal that we may sell this next month. And so ultimately, we're looking at more markets, right? We still like Texas. Texas is a huge market in general, right? We like San Antonio because, San Antonio price points make sense. And it's an operator's market, meaning that a lot of people just struggle to operate well there, right? Whereas we have, I think we have good operations, and that's helped us kind of really be key to success. And we do like other markets. We want to, we really want to expand into Tampa and Orlando, right? Orlando's a little bit expensive, but we, there's several other markets that we do like, and we're trying to put together kind of active steps to expand into them. But it's ultimately we need to find a deal that we are comfortable with, and a deal that we can perform on what we're trying to perform on.
Okay, I know we're getting at the top of the hour, so I do want to be respectful of your time. I do have another question that just came in. So yes, this webinar is being recorded. You will absolutely be able to access the recording via our YouTube channel or visit our website. Also, to a representative from Advanta will follow up with you just directly just to see if you have any questions. Another question that just came in: can sophisticated investors invest in your deal?
Sorry, can what invest in our deal?
Like sophisticated investors or more so?
Sophisticated investors. No, good question. That's deal specific. So we do have some deals that are sophisticated and accredited, and we do have some deals that are accredited only. And so, yes, we accept sophisticated investors. Yes, we will continue to accept sophisticated investors, but it depends on the deal.
Okay. Okay, so again, we're coming to the top of the hour. Any last golden nuggets that you want to share with our audience?
No, multifamily investing, I love it. It's a lot of fun, and it's just, get educated, get out there, get educated, and take action. Right? It's kind of my big feedback to people.
Excellent. Well, Ferris, thank you so much. I know we've talked about putting this presentation on for a while, so I'm really excited that you're able to be our featured speaker today. Again, my name is Renika Lightborn. If you have questions, you want to know more about self-directing, you want to talk about your scenario, definitely feel free to reach out to me, and I'd be happy to assist you.
No problem. Thank you very much, Renika, for hosting it. Definitely appreciate it. And I do highly recommend you all reach out to Renika. Definitely a class act. So highly recommend them as well. We do have several investors with them.
Thank you, everyone. Thank you all for joining. Have a wonderful day.
You too.